Our guest says National Bank's offer to buy Canadian Western Bank reflects an expensive valuation, and the expected addition to profit that is expected to take 3 years until after the deal closes is questionable. We're joined by Bloomberg intelligence analyst Paul Gulberg. He's in Princeton. Thank you very much for joining us.
Thank you, Andrew. Thank you for having me.
One thing that I think jumping out for investors here is that National is paying 1.4 times book for Canadian Western Bank, so that looks fairly rich.
It is quite expensive considering where the peer group is trading. The larger banks even, they trade in more of 10 to 12 times or so. So that's expensive. What they do talk about, they talk about fully synergized valuation 3 years after the close when they can put all the cost savings in. That's about 9 times. So that looks more reasonable, and that kind of looks in a similar neighborhood where RBC paid for the HSBC on a fully synergized basis.
3 years, it's quite a long time, isn't it, to wait for your earnings per share to actually go up from an acquisition?
It is, and I would compare it again to RBC, HSBC, as they're working through their synergies right now. Their period to get fully synergized is about 2 years. And also, if we think of the experience of RBC getting approval for HSBC purchase, it took them a little bit longer than originally anticipated. So National is saying the deal will likely close at the end of 25, so they're giving themselves essentially a year and a half.
The interesting thing here is they're talking about cutting $270 million in annual savings, but there's going to be $400 million of integration costs. But any cutbacks, I presume, especially in Alberta, could run into political opposition if jobs are lost.
It is definitely a possibility, but from a bank overall perspective, cutting half of the cost of the target has typically been a common thing for the regional bank acquisitions in Canada and in the US. So again, RBC, HSBC kind of similar. They might have some opposition, but there are also a limited amount of branches, so I think a lot of the cost cuts are going to come from technology, from back office. So they should be able to get those through.
Yeah, there is actually a surprisingly small number of branches in Canadian Western Bank. I'm going to look up the number, but it's not that big. Yeah, it just has less than 40 branches. So in some ways, it's not a huge company. I know it's being valued at 5 billion Canadian here.
Yeah, it is true compared to the other banks. So when we added both banks together, they said 484 billion of assets. That's still about half of the next biggest one, CIBC.
Right, and as you know, the equity holders in Canadian Western will get less than 11% of the merged bank. I'm just trying to think. I mean, obviously, the action of any government is hard to predict, but after waving through the RBC takeover of HSBC, I guess the federal government can't block this one.
No, they probably will be fine with it. The branch footprint is pretty diverse, so there's not much overlap. Also, there are a lot of businesses that are complementary, but there are certain businesses that National has due to size that Canadian Western doesn't. So there's not that much overlap that should really raise a lot of red flags.
And what about a rival bidder? With the fairly rich valuation being put on here, it could be tough for another bank to convince its shareholders to go along with that.
Well, I would say two things. One is, I absolutely agree with you, it would be hard to find another bidder. Two, the other bidders would be the 5 larger peers who are diversified and who have most of that footprint. You mentioned the 40 branches, so for them it's going to be kind of a small thing to go after.
We talked to Nigel D'Souza, an analyst from Veritas today, and he said the return on equity from Canadian banking, personal and commercial banking in this country, is rich by even international standards. Does that square with your analysis?
Yeah, it's absolutely true because the efficiencies in Canadian banking are typically better than in the US and in some of the European banks internationally in general. So like in the US, if you look at the efficiency ratio that shows the cost relative to revenue, it's about 60%. For a regional bank in Canada, it's in the 40s. So it's much more efficient operations, and because of that, it produces a better return.
Is that partly because they can price products higher than other banks in other countries?
Partly it's because there are fewer banks, more concentrated market. So yes, there are some products that can get better pricing, and also there's a lot of efficiency. But again, I think Nigel has talked about it also in the past, but there's a lot of concentration of banking, and because of the large scale, you can extract a lot of efficiency from it, especially for larger peers.